2024 is just around the corner, and the stock market is right back to hitting all-time highs. This is leaving many investors wondering where value is in the markets today, and which stocks could still be looking cheap. So in today's video, I want to provide a list of 5 stocks that I personally think are not overvalued today, and explain why. Now, if you're new here, I started a challenge on my channel to see if I could invest $1 million and outperform the S&P 500 as a way to publicly track the performance of my picks and my investing style. So far, the portfolio is up 44% since its inception, versus the S&P 500's 25%, which means I am outperforming by 19% now. The stocks we are going to discuss today are all within this portfolio as well, and if you would like to follow my channel's performance and the stocks that I find interesting, then subscribe to the YouTube channel, as I will be doing regular updates in 2024. But with that being said, let's now dive into the video, and let's head to the first stock that I do think is looking attractive today. This one is Amazon, and I'm sure that we all know what Amazon is and what the company does. Amazon stock has also had a very strong year in 2023, with the stock being up roughly 80% year to date. In my opinion, the stock has rebounded so much due to a massive increase in Amazon's profitability over the year. Amazon's operating cash flow has absolutely skyrocketed to an all-time high, and the trend is clearly going up now. This has caused Amazon's price to operating cash flow to still be near historical lows. And the market seems to closely track Amazon's price to operating cash flow, and this is the metric that investors seem to care the most about. So the fact that Amazon is trading near its historical low price to operating cash flow does suggest that the stock could be looking undervalued or potentially cheap today. Amazon has also continued to sign on new major AWS clients, and it seems like more and more businesses are becoming customers of Amazon's every single week. However, what I personally love about Amazon is it has multiple growth engines. AWS is now doing about $23 billion in revenue per quarter and growing about 12% year over year. However, third-party seller services is doing $34 billion in quarterly revenue and growing 20% year over year. This is a 50% larger business, and it's growing even faster than AWS. Additionally, Amazon produced $10 billion per quarter in subscription revenue and $12 billion in advertising revenue, and both of these businesses are growing faster than AWS as well. So to me, Amazon is so much more than just AWS, and it has huge businesses still growing at incredible rates. So I think Amazon will continue to perform well over the long term as the business continues to grow and as its operating cash flows continue to make new highs. Now, moving on to the second stock, this one is CP, which is one of Canada's 2 major railroads, and this company has a rail network that does expand all over North America. This is also the most recent stock that I have been adding to the YouTube portfolio, and I made a full dedicated video to why I have been buying CP recently. So let me summarize some of the key points here. I think CP has the best rail assets in the world, as it is the only network that connects Canada, the US, and Mexico. More and more companies are nearshoring their manufacturing, which is moving it out of China and over to Mexico. This has caused Mexico to become the US's largest trading partner. With CP owning rail that moves goods from Mexico to the US, it stands to see lots of benefits from this. CP is also trading for a price to operating cash flow of about 15 when you adjust for the Kansas City acquisition that it recently did, which is below the company's historical averages. The business is also projecting to grow its earnings per share by 10 to 12% annually over the next 5 years, with a 90% cash conversion rate. This means that almost all of the earnings per share growth will be translated into cash flow growth, which should provide roughly double-digit cash flow growth as well. So CP is trading for below historical average price to operating cash flow ratios, while also projecting to grow its profits at double-digit rates, or close to double-digit rates. I also think railway businesses have some of the strongest moats in the world. There is simply no better or more efficient way to transport goods throughout the economy, and I do not see this changing anytime soon. There's also no new rail companies popping up, and in fact, there continues to be consolidation in the industry. So the existing players are most likely going to remain for decades, if not centuries to come. CP is really a stock that I feel like I do not have to worry about over the long term in my portfolio. And I also do not think that the stock is overpriced today. Now, moving on to the third stock, this one is Brookfield Corporation with the ticker symbol BN. Brookfield is a massive conglomerate which owns dozens of businesses. It is also one of the world's largest alternative asset managers. Brookfield Corporation is the largest position in my portfolio, and it is one that I cover on the channel all the time. And the reason that Brookfield is the largest position in my portfolio is because it is one of the only stocks left in the market that I truly believe is still undervalued. Stocks have been absolutely ripping in 2023, which has led to not many being cheap anymore. However, Brookfield Corporation is still trading for roughly 12 times distributable earnings, which is the company's metric for free cash flow. The business is also expecting to grow its free cash flow by 25% annually over the next 5 years. Brookfield at its core also has a culture of value investing and buying assets that are currently out of favor. Because of this, they deployed a record amount of cash in 2023, and it was one of the most active buyers of assets in the world for the year. These acquisitions should start producing meaningful cash flows for the business sometime in 2024 as well. Additionally, Brookfield raised a record amount of cash in 2023, which will be deployed throughout 2024 for more long-term growth. It's rare to see a business trading for roughly 12 times free cash flow, while also projecting to grow its free cash flow by 25% annually. The management of the business is heavily invested in the stock as well, with the management owning roughly 20% of the total company. I love to see high insider ownership in the businesses that I own because it really does align the incentives of the operators of the business and the shareholders of it. So I think that the stock will outperform due to its low cost today, high projected future growth, and a history of excellent execution. And for that reason, I would not be surprised to see this business outperform in 2024. All right, moving on to the fourth stock now. This one is Fortinet. This is one of the leaders in the cybersecurity industry. The stock has also gotten beaten down in 2023 due to lower revenue growth projections. However, when you take a look at the business's revenue growth over the long term, it has been incredible. If we turn on the growth rates to this chart though, we can see that its growth rate is definitely slowing down right now, but this also is not the first time that this has happened. Back in 2013 and in 2017, the business was seeing similar growth rates to its revenue. And in the most recent quarter's conference call, the CEO did say that the business does have a more cyclical nature to it. Therefore, its revenue has periods where it grows rapidly and periods where growth slows down. Fortinet is currently in one of those periods where revenue growth is slowing. If we also take a look at Fortinet's historical price to free cash flow ratio, we can see that back in 2013, the stock was trading for roughly 18 times cash flow. And in 2017, it was trading for roughly 17 times free cash flow. Both of these times were when the business was historically seeing a slowdown to its revenue growth, as we saw earlier. The stock is trading for about 21 times free cash flow today, which is not as low as it has ever been, but it is still well below the business's historical average price to free cash flow of about 26.7. Therefore, I personally believe the business is selling below fair value today. It is also rare to find such a high quality business that is growing this well over the long term to sell for price ratios within this range. Fortinet is also projecting to resume double-digit growth rates in the second half of 2024, so I do believe that this is just a short-term thing that the business is experiencing. What I also like about Fortinet is it does have high insider ownership, and the business is still founder-led. So in conclusion, I think that this is a growth stock selling for value prices today due to the short-term headwinds that the business is facing. But again, I do think that these are just short-term headwinds and that the business will continue to grow strong over the long term. And in the meantime, I do think that it is offering a discount and selling below fair value. And for that reason, I think that it could outperform in 2024. All right, moving on to the fifth and final stock. This one is Equitable Bank, which is a smaller Canadian digital bank. Equitable Bank has been growing insanely well. If we take a look at its historical quarterly revenue growth, we can see that it is sitting at an all-time high right now, and the revenue growth has been absolutely exploding. This is the exact same story for the company's net income or earnings growth as well. It is currently sitting at an all-time high, and net income is absolutely exploding too. Now, it's interesting is Equitable Bank still trades for low price ratios, even when we compare its price ratios to the overall banking sector. It also recently reported its third quarter 2023 earnings, and I went through all of the highlights in depth for my Patreon community, as well as shared another stock that I have been buying that the YouTube channel has not seen. I do own a few smaller cap stocks that I do not share publicly, as they have very little volume and are kind of like my hidden gems. So if you would like to access my Patreon only videos, which share my in-depth thoughts on stocks and additional ones that I own and am buying, then you can become a Patreon member. I will leave a link in the description if you would like to join. But here are some of the high-level highlights from Equitable Bank's most recent earnings report. The business reported earnings per share for the quarter of $3.80, which was up roughly 20% year over year. Book value was also up 12% year over year, and the dividend was increased 5% quarter over quarter and 21% year over year. Equitable Bank also grew its customer base by 30% year over year. Equitable Bank also hit all of its guidance for 2023 and surpassed the high-end guidance for earnings per share, return on equity, and pre-tax income. The business has a history of doing this and beating its own projections that it ends up laying out. Equitable Bank's loss ratio is well below its peers and extremely low. Its loss ratio is essentially 1/10 the average in the industry, so its loans are incredibly stable and they're not really going bad at all. Moving on to its cash flow statement, here we can see that it produced $141 million in earnings for the third quarter and did only $1 million of stock-based compensation. It has a history of very low stock-based compensation, which means it is not diluting shareholders aggressively to pay its employees and its insiders. I absolutely love to see this. And whenever I see a business with low stock-based compensation, while the profits are growing incredibly well, and in addition it has high insider ownership, then again, I think that this is just awesome, and I love to see it in my own holdings. Also, the dividends paid were only $14 million on the quarter, which is roughly 10% of the net income the business generated. This means that there's a lot of room for Equitable Bank to continue growing its dividend in the future, and it's not a huge weight on the business's net income. The other Canadian banks all pay out roughly 50% of their net income as earnings, and if Equitable Bank did this, then it would have a 10% dividend yield today on its shares. It also gave guidance for 2024, and it is projecting to grow earnings per share to $12 per share, which is 27% year-over-year growth. Pre-tax income is projected to grow by over 20% as well, and they are projecting to grow the dividend by over 20% again next year. Book value is projected to grow by 14% next year as well. So this is a business that's growing its earnings and dividend by 20% annually, while also trading for a 9 price to earnings ratio today. However, with $12 in EPS projected for 2024, it means the business is trading for a forward price to earnings ratio of 7.1 today. I think that this is a very low price for a business growing so well, and projected to continue doing so in the future. It's rare to find a business with a 7 forward price to earnings ratio and 20% projected growth. So even though Equitable Bank is currently hitting all-time highs, I think that it is still arguably undervalued and could outperform the market going forward. And again, I did an even deeper breakdown for my Patreon subscribers and shared another business that I have been buying recently. You can join my Patreon to get all of these videos and alerts to what stocks I am buying and selling in my own portfolios. But with that being said, that is going to wrap up the video for today, everyone. And if you did enjoy this video, then please remember to leave a like on it, as it does really help out my channel. But with that being said, thank you all again so much for watching. I truly do appreciate it, and I really hope to see you all again in my next one.